So today we finally got first quarter GDP numbers, and of course I'm sure that these numbers will be revised downward because the first estimate is never the same as the final number, and I highly doubt that they are going to estimate things to the downside initially. Government tends to always lean on the side of being a little too optimistic because you wouldn't want to spook financial markets, and despite the fact that we are at negative 4.8%, annualized for the first quarter, meaning that that's the rate. It's like saying that you're at 70 miles per hour. You didn't literally go 70 miles. We haven't literally contracted 4.8%. However, if we continued contracting at the rate that we did in the first quarter, which of course does not include April, when the lockdowns really set in earnest, we would lose 4.8% of GDP over the course of the year. And so that's pretty bad, considering that GDP growth has been pretty anemic for the entirety of this current business cycle in America. Ever since the last recession, there really hasn't been any years of big growth. We never had a year of 4% growth or anything like that. It's one of those things that actually I think Jeb Bush was running on that in 2016. He's saying, hey, we should strive to achieve 4% GDP growth, which of course is utter nonsense. The amount of pain that would be necessary to get the U.S. economy lean enough to where it could grow at that kind of a rate again, it's politically impossible. And so I didn't actually look at what the average has been over the last 3 years, but usually we grow around 2% a year, so 4.8%. Is almost 5%. Once they revise it up, I'm sure it's going to be, that we were declining at 5%. So if we continue to contract at this rate through the entirety of the year, we'd wipe out 2.5 years of GDP growth. And you would think in that case that since the stock market is supposed to be related to the economy, because as I've discussed before, the whole idea is that when you buy stocks, you're buying a share in these companies that are real things that operate in the U.S. economy. So if you say buy, an index fund, you're buying a share of a good chunk of the U.S. economy. But if the U.S. economy contracts by 5% and it loses 2.5 years of gains, well, you would think, well, gee. Shouldn't my stocks lose 2.5 years of gains too? And the answer is, of course not, because the price of stocks means absolutely nothing. Stocks right now, the S&P is almost back to 3,000. So what have we lost? A few months of growth in stocks, because the peak was somewhere around 3,300 something for the S&P, and that was a huge blow off top. And even with all of this terrible news today, of course, stocks are just to the moon. And why is this then? Why, if the economy is in total free fall and there's no real sign that anything's going to, change here in the near future, that we don't really have too much hope that the lockdowns are going to be completely lifted? And of course, once the lockdowns are lifted, it's going to be a very, very long road ahead before we start rebuilding the economy that has been shattered by this, this so-called pause in human activity. You don't really pause the U.S. economy. In fact, somebody came up with a pretty good analogy. He said, hey, the economy's not a machine; it's a living organism. You stop an animal's heart. Guess what? It's dead. And it has to degrade and go back into the ground, and then nurture some plants, and then those plants will be eaten by another animal and sustain it. So it's not that everything in our economy, the value of everything's going to go to zero, but it's our economy is going to be worth the sum of its parts, because the economy overall is just it's going to be killed. Now, on the reopening front, there's also a lot of optimism today because there was some news that came out about the trials for remdesivir, which is an antiviral drug, and that to me didn't seem too promising. But then again, when they do these studies, it doesn't really, it's not a great representation, because they basically, they tested two groups. The placebo group died at a rate of like 11.6%, and the test group died at a rate of 8%, I think. And so since both of those numbers are so high, I would imagine that they're testing people who are already gravely ill and likely to die. People who are in, bad categories, I guess, are the folks who got the drug. But of course, the way antivirals work, from what I understand, is that the worse off you are and the further along in the infection process you are, the less the drug can help you. I mean, the drug really is going to help you if you take it, before you get sick, but when you're infected or just starting to get symptoms. So if you're using the drug on people in the hospital, that's not really where it's going to shine. So to me, the test didn't, it certainly didn't rule out the usefulness of the drug. And of course, it did show that there was a difference between the test group. But with everything like this, there's going to be a margin of error. You don't know necessarily if that entire difference, in the death rate is made up by this treatment. And so stocks, going to the moon today over this news is certainly not, an example of efficient markets pricing in new information. What it is an example of hopium. People are looking for any excuse to buy stocks because there's plenty of liquidity in the system to facilitate that. And just in case there was any question about whether or not there was going to be plenty of money to divert into the stock market, the Fed came out today and held one of their normal press conferences, and they didn't cut rates because of course they're already at zero. They didn't announce a new round of QE because they're already on QE forever. They've announced that came out over the weekend that they're just going to print as much money as they need to ever. We're on full whatever it takes. Just print money, buy up whatever in whatever quantities, buy up all the debt that they can. Eventually, probably they'll buy up stocks. Right now, the big thing is that Jay Powell is holding firm that he won't go negative, which I guess, hey, there's at least some consolation for us hard money people. Jay Powell's not going to bring out negative interest rates. But he thinks that, as long as I don't actually go negative in a nominal sense, that, hey, we can just print as much money and do it through QE, and that somehow QE is not as bad as negative interest rates. We can do we can have all the same, stimulus that we would get from, an extra money in the system from pushing rates negative just by buying up mortgage-backed securities and corporate bonds and government bonds. And of course, driving all the private investment into the stock market. But, what this really showed is that while the Fed, said, hey, we're doing whatever we can, they didn't announce anything new that they could do in the event that things get worse. So after everything that the Fed's done, the Fed's thrown everything in the kitchen sink at this market. If we have another downturn from here, what are they going to do then? There's no room to cut. You're already doing QE infinity in whatever quantities necessary, whatever that means. It means as much as we need to pump the markets up. Well, if you're doing all that and we still have, even a slight correction, a 10% drop again, what are they going to do? The Fed has backed itself into a corner, and I think it's going to be, a whole new world once they have there's the first test of this new reality of the Fed having absolutely no ammo left, to where there's no hope for anything better. As soon as we have some kind of a drop, a lot of people are going to start questioning the efficacy of the Fed, because if the Fed really can prop up markets forever, what they're doing right now should do that, because the Fed is saying, I guess the next thing they could do, let me correct myself. If there is another drop, then what the Fed is just going to do, because I still don't think that Powell wants to go negative, because they've seen how that didn't work well in Japan and Europe. The mainstream accepts at this point that negative interest rates are not a good idea. But what he could do is try something that, is new, at least to Americans, and that is the Fed could directly buy stocks. And in that case, well, then, of course, the price of stocks would just be something that the Fed targets. It would be markets by decree. We would have a Politburo determine what the price of stocks should be, just like they determine what interest rates should be. And so in that case, the nominal price of stocks could never go down. But of course, that creates other problems because, like I was discussing recently, what that would do is if the entire economy collapses and the Fed refuses to allow stocks to depreciate, well, then all you're doing is just exacerbating wealth inequality, because you're making all the rich people whole when everyone else has gone broke. And that's how you get the French Revolution. Because what the Fed's doing right now, all of these new measures that they've announced are not going to help the real economy in any sense. They had already done everything they could to help the real economy by lowering interest rates to zero. Once you've lowered interest rates to zero, there's nothing else that ordinary people can benefit from that the Fed is doing. The only people who can benefit from the Fed, doing lots of QE and buying up financial assets are people who own these sorts of assets. And so there's not even an argument that can be made that, once the Fed has lowered rates to zero, that anything else they do from there, has any positive effect for ordinary people. At that point, everything is purely just helping the rich. And of course, I don't think that lowering interest rates is great for ordinary people either, because it punishes savers and distorts our economy, and ends up pushing people into jobs that will probably disappear during the next recession, kind of like what we're seeing right now. Of course, lots of restaurants and things, just as a quick example, not going to reopen. So if you work in one of those restaurants, or in any restaurant, there's a pretty good chance that you'll never go back to that job when all of this is over. So that's about it for our Fed update for today. They really didn't say much different. Powell just kind of continued. Actually, I guess what he said was he pretty much, the difference was that he made it abundantly clear that, which is something that I already knew anyway, but the mainstream now understands that Jay Powell has no intention of ever raising rates or ending QE, because he said that the conditions for changing the policy that they're on now, to being less accommodative, would, be predicated on the economy being solidly on the road to recovery. Which is, subjective, but a pretty strong language. And of course, the Fed, I don't think, would ever perceive that, at least, no time in the foreseeable future. So we've got 0% rates and QE infinity forever, which to me is nothing new. This is, what I've been expecting for a long time. I've been expecting this since the Fed started raising rates back in, 2017 or 2018. We knew that they'd get to this point and that there would be no way out. So with that said, if you gained anything of value out of this video, I'd appreciate you clicking that like button and sharing this video. And if you haven't already, please do subscribe, because I do upload every day and I'd hate to have you miss one. So I'll see folks back here tomorrow.